today's founder interview, we speak with Fernando Anelucci, a guy that has mastered the art of thinking big. At age 16, a single book changed his life, steering him away from the traditional path his immigrant parents had envisioned for him of going to college and getting a good job. Today, Fernando has built a $240 million self-storage empire across 24 states. This guy has so many actionable and just useful tips for growing your mindset and building your business that I couldn't fit everything into one video. Part 2 of the interview, and you don't want to miss it, is linked down in the description below. Now let's meet Fernando. Can you tell us a bit about yourself and your background?
Yeah, so son of 2 immigrants. My parents are from Brazil. Kind of typical immigrant story. Education was really focused on when we were younger, almost to, let's say, a detriment where, the only path forward for most would be to, go to school, get a degree, and then go work at some, Fortune 50 job. That ended up not being the case for me, or I guess somewhat not being the case. When I was 16, I read Rich Dad, Poor Dad. Changed my life as far as the ways that I learned that you can run businesses, you can invest in real estate, etc. I did still go to school. I got an engineering degree. I did get a job at a Fortune 50 company, Fortune 49 company, but lasted about 13 months. From there, went into flipping houses, buy and hold real estate, primarily single family and multifamily. And then very quickly, I realized that that was not what I wanted to do. The stress, the laws were extremely in the favor of the tenants for most of the markets that I was in. And I decided about 7 years ago to get rid of those businesses. So shut down the 4 or 5 businesses that were related to habitation-based real estate, and then started investing in self-storage full-time. And since then, in the last, call it 6 years, we've done a little over $240 million worth of storage. It's 53 deals across 24 states. And we probably have another 50 to 60 million lined up for the coming 12 months.
And so I think you kind of dove on that a little bit. What is self-storage syndicated equities?
Yeah, so our company is, it's a syndicate. So we raise capital from accredited and non-accredited investors, depending on the Reg D filing that we decide to go with. And then we provide a return on their money for doing basically all the work. So I go out, I get the debts or the construction debts. I put together the operating companies, the construction companies. I get the buyers and the sellers together, et cetera. And then we take in passive investor capital, typically anywhere from $50,000 to $500,000 per investor. And then within usually 3 to 5 years, we return all their capital plus a return. So typically we're in the 18 to 25% internal rate of return target, and then equity multiple of anywhere between 1.8 to 2 times equity multiple on the deal.
And so I think you kind of dove into what inspired you to start SSSE. What actually inspired you to go this direction instead of, a different direction?
Yeah. So real estate is a very capital intensive business. You need a lot of capital. So one half of that equation is debt, which is a little bit easier to get. I'm not saying it's easy, but it's easier than equity, I would say. Go to banks, get your, construction loan. Let's say I'm doing a $14 million build. Bank is willing to give me 9 to 10 million in debt. That means that I need to come to the table with 4 to 5 million in equity. So I can do just that one deal, and then that's the only deal that I have running until I get my money back out of the deal, which could be 3 to 5 years. Or I can put 10% of that $4 million equity in. So I'll put 400,000 in my own cash, and then the other 3.6 million I raise from equity investors, and I give them a solid return. And that allows me to go out and do 10 deals when originally I was only able to do 1. And yes, I have to give away a lot of the ownership of the deal, but I always like to say I'd rather have a piece of the watermelon than the entire grape, right?
Right. So it's that leverage mechanism that you're really able to capitalize on.
Yeah. OPM, as they say, other people's money. And that is in both forms of, debt and equity. For those that are listening, OPM is a classic term that Robert Kiyosaki uses across all of his books.
You did a written interview for me, which I'm thankful for. I was able to kind of come up with really in-depth questions for this interview because of that. In that written interview, you mentioned that you've tried multiple businesses before starting SSSE. What were those other businesses? Were they also real estate related, all of them, or?
No, I mean, it's going all the way down to when I was a kid, buying candy bars at the store and then selling them at school until I got shut down for doing that. Apparently I wasn't allowed to. So that was like the first time I started arbitraging. In college, when I was 19, did a kind of like college painters. Ours was called College Works Painters, where after classes on Friday, I'd take a bus back up to Chicago. I'd knock on doors during the winter and I'd say, hey, your house is looking pretty rough on the exterior. What if I give you a free estimate to paint it? And then if they agreed to take us up on our offer, I would take a 10% deposit and then book their house to get painted in the summertime, hiring all my friends from school. So that was another business that I ran. I had a company creating, like phone apps when apps were a new thing. I think this is probably in 2013, 2014. And then eventually I stumbled upon, well, not eventually, I've been reading books probably for 8 years up to this point about about real estate. And then I said, let's go into this real estate side. I just need to figure out how to get the capital for it, right? Because originally I was trying to start businesses that I could do with only my own capital. But then when you look at some of the biggest businesses in the world, a lot of them, they take outside capital to get started and get those economies of scale. So then, in 2014, started flipping houses, flipping contracts on houses, something called contract assignment or wholesaling. Some of your listeners might be familiar with. And then from there, taking those checks and using them for down payments on rental properties. And then eventually what I learned is that real estate gets easier every time you add zeros. So instead of doing a $50,000 deal, do a $500,000. Instead of $500,000, do a $5 million. Instead of $5 million, do a $50 million. Every time you add a zero to the deal, it gets easier to get debt. It gets easier to get equity. It's easier to operate because economies of scale. It gets easier on your time required because then the deal has enough capital in it that you can pay third parties to do things for you instead of you having to be the ones fixing toilets and collecting rents, etc.
I think that would be, for me, for sure, that a big misconception. Like the littler deals would be easier to do than the bigger deals.
Yeah, believe it or not, it's just not the case. Very counterintuitive.
I don't always ask about revenue this early in an interview, in fact, ever. But I think asking it at this point in the interview would build some context for the audience on just the massive scale and the business that you have made. If you wouldn't mind sharing some numbers.
Yeah, absolutely. So we kind of have three and a half legs to the stool of our self-storage company. So the first is buying what we call mom and pop self-storage facilities. These are typically smaller than what like an institutional company would want to buy, less than 60,000 square feet, operated by somebody that's, I wouldn't say very professional at it. They usually own 2 or fewer facilities. And what we do on this side of the equation is we will come in, we'll standardize the operations, put professional management in place, we'll raise revenues, drop expenses, and then we'll put those deals together into a larger portfolio of, say, 10 to 15 self-storage facilities. Those types of deals that we buy, ideally, we want them to be at about $50,000 a month in gross revenue. That's once they be, that is a stabilized facility. It is one that an institutional buyer like a publicly traded REIT is interested in acquiring from us. On the other side of the spectrum, so the second stool or the second leg of the stool is we do these ground up developments. These are these class A, state of the art, 3 or 4 story buildings using all the latest technology. These deals are huge. So unlike, say, those mom and pop deals that we're buying for $1 million to $3-4 million a piece, these ones we're buying the land for $500,000 to $1 million, and then we're putting up a $10 to $14 million facility on that land. When those are stabilized, the revenue is typically in the $1 to $3 million range, depending on the size and the location. So, much larger scale, right? When you're going from, say, $200,000, $300,000 a year up to $2 to $3 million a year. And then the kind of middle peg there is like the transitional deals that have an existing component to them, but there's also a construction component. So that could be adaptive reuse conversion, which is me buying dormant big box retail stores like Sears buildings or Walmarts or Kmarts that went out of business for whatever reason. And there's a shell there already. So it kind of reduces my construction component. All I really need to do is go inside that shell and build self-storage units themselves. Or it may be buying a mom and pop self-storage facility that happens to be 5,000 square feet, but it comes with an extra 5 acres of land attached to the property that's already zoned for self-storage. So then it doesn't take 1 to 2 years to go through permitting entitlements, rezoning like we do with the land deals, but we can buy it. There's already existing cash flow coming off to pay off, construction loans, or even to give out distributions to our investors. But then we're able to double the size of the facility up to 65,000 plus square feet, so that now it is an asset that an institutional investor would be willing to buy. And those deals are typically like in the, 1 million a year to 1.5 million a year in revenue. Currently in my portfolio, because I've sold off a lot, my business is not to buy and hold forever, because then the returns are too low for our investors. So my business specifically focuses on that very heavy forced appreciation that you create by doing construction, by increasing the operations. And once it's stabilized and turns into an armchair investment, then we sell that off to somebody else that is willing to pay a much higher price and, collect a 6% return or a 7% return, versus my investors that are getting, on the low side at 18%, and then on the higher side of what we target, probably a 25 to 27% internal rate of return.
I'm hearing a lot of like value add. That's kind of the path that you
That's
take.
all we do. Yeah. We don't buy stabilized assets. That is not our business. We sell to other people that buy stabilized assets from our work. So right now, my portfolio, I have 11 facilities currently that we're operating on. So you can kind of extrapolate. It's a mix between those three types that I was telling you about. So you can extrapolate where our annual revenues are. Every once in a while, usually 3 to 5 years, I'll sell off a large portion. So it's basically like my portfolio holdings go like this, and then I find a seller that's willing to buy 10 or 15 of them, and it drops again, and then I rebuild it, and then it drops again. So yeah, we just did this maybe 2 years ago. I sold 15 self-storage facilities in a span of 12 or 18 months. That was a really big pickup. Our investors made some really good returns, and now we're doing it again. And we'll probably sell our next portion of deals within the next 18 to 24 months, as we'll probably try to sell everything off again and then start all over again.
I feel like there's so many questions there that I'm missing to ask. So have any way to like measure this? Like, do you know how many people you've gotten through podcasting, buyers and sellers?
Yeah. So, not necessarily tracking it down to a channel level. You can do that, but things get muddy, right? Because what if someone reaches out to you from your website because they heard you on a podcast and then decided to go to your website to send out a thing, or they contacted you on Reddit, but then they went to do some research on your website or on your YouTube channel, et cetera, and then so it's, the way that we look at it is how we split our tracking is, are we getting leads that are coming to us, which means it's coming from our, pull marketing multi-channel strategy, or are we getting these leads from push marketing because we're dialing for dollars, sending out letters, text messages, showing up to seminars and events. And so we track it like that, because we found that we don't really need super insane analytics. We're not writing some, .com website or something. So this is good enough. And then I like to track more downstream metrics. So how many new equity investors did I sign up this week? How many new debt lenders did I sign up this week? How many sellers, brought us a property for us to underwrite to see what we want to buy? These are the more important metrics to us than, hey, did this person come from YouTube, or did this person come from Instagram, or from, LinkedIn, et cetera? Because that's really what makes a difference in my business, is where's the money? Where's the money flowing, not where the money flowing from.
And so the last question I'd like to hit on that is, I can understand why an investor would come to you through podcasting. They see that library of content, they watch you for a little bit and they know this guy knows what he's talking about. But why would a seller want to come to you instead of, pushing that public to a public deal?
Yeah. So, there's a lot of reasons. Sometimes it's a situation where they want to keep the transaction private, so not in the eyes of the public. They don't want 10,000, 30,000 people all of a sudden seeing that they're selling one of their assets, because that can cause liability. Especially if people think that you're about to get a large paycheck, and then all of a sudden, it's like when people win the lottery, right? People come out of the woodwork to see if they can pick a little bit of that cash off of you. That might be one reason. Another reason might be they want to make sure that they're working with somebody that can close, because doing a real estate transaction, even if you're the seller, requires a lot of work and time, especially for self-storage facilities. I need documents. I need tax returns. I need rent rolls and profit and loss statements. You could put all this effort into doing a deal with somebody, and then after 90 days, when they're supposed to show up to the closing table, they say, "Oh, I don't have the money," or "I wasn't able to secure debt because the lender said this is your first deal and we don't lend, to first-time self-storage investors." So just by having this basically this virtual credibility package that's all over the internet, people can say, "Hey, Fernando does deals. He's done a ton of deals. He knows how to close deals. He knows how to do them creatively. He has his own debt sources. He has his own equity sources." Like there's much less risk signing a purchase contract with Fernando than signing one with, Joe Blow that he just heard about self-storage and he's going to go out and do his first one. So that credibility, it counts for something.
So your business has grown, you said it fluctuated here and there, millions and millions of dollars worth of assets though. What systems and strategies have you had to put into place to manage like this rapid growth and ensure like the quality control across the properties that you hold?
This is a great question. I wish more people would think about this question before they go into business. So what people don't realize is your business, your systems will break, and they usually break at pretty regular intervals. So, anytime you triple the size of your team, anytime you 10x the size of your team, all of those systems that you used prior, like for example, a system that you use just for you and your partner, all of a sudden you get 3 new employees, and the systems that are using just for you and your partner don't work because the employees need input as well. And then all of a sudden you go from 3 employees to 10 employees, and now the systems you're using with 3 employees breaks down completely because it can't handle the scale of the 10 employees. And then 10 to 30, you're going to break again. And then, 30 to 100 or 30 to 90, and it breaks again. Realizing the first step is knowing that things are going to break and that the systems that you started with are not going to be the systems that you end with. And not only the systems, but the people you started with may not be the people that you end with, including me, the CEO. When you look at large companies, typically the founder, it's very rare that the founder is still the CEO once it becomes publicly traded, right? So you have to realize this. So how do you manage this growth process? There's a lot of great books on this subject specifically. One of the books that I really love is called Traction by Gino Wickman. That's the EOS system, or the entrepreneurial operating system. And it's a way to run a business, not a business in itself. How do we control metrics? How do we control the people? Do we have the right people in the right seats? Maybe you have the right people, but they're in the wrong seats, or you have people in the right seats, but they're the wrong people for that seat. Making sure that you're, nowadays there's a lot of issues with like security of IT. We're seeing everyday hacks happening and people getting ransomed because they don't have backups of their entire, call it Google Drive, and then some bad actor locks down their Google Drive and says you have to pay me 100 Bitcoin or else I'm just going to delete all your files. But then what? Like, did you account for having to pay ransomware, like a ransom? Absolutely not. So these are the kind of things that you have to realize as you're growing. So that's just from the operating system side. But then now let's look at it, because I'm a real estate investor, from the debt and equity side. So very quickly, as you're growing, you're going to run out of your own money. Then you're going to run out of your family's money. And then you're going to run out of your friends' money. And then from that point, you go to friends of friends and friends of family, and you're going to run out of their money very quickly, right? So now you have to create an entire new business just to get equity into the door, because you're tapping people out very quickly, especially if you're doing the size of, commercial size real estate deals, where one deal you need $4 million in equity or $5 million in equity. So we had to create a capital raising company inside of our company, basically, which is one of the strategies of using the podcast. It allows me to get my experience out to people that are interested in investing in self-storage and want a very good sponsor that has a great track record. But then now the money's come in. Now, how do you manage all that money? Right now, you need a whole investor relations department and investor relations software. So we had to get a software that helps manage everybody's money, sends out all the K1 reports, all the quarterly updates. They can log in and see what's going on with the property. And so over time, like, that keeps going. I'm sure very soon all that stuff is going to break for us again. And we're going to have to go, to one level up and start doing, fund level equity raises. So instead of raising $5 million for one deal, I have a $20 million equity fund that I can do multiple deals in and out of over a period of 5 to 10 years. So yeah, very, very good book. Very good question. A lot of great books out there that answer, how to run this. Traction is one of the ones I'd start with. The E-Myth by Michael Gerber is another one that I'd recommend. I'm trying to remember the name of the book on specifically systems breaking, but it's escaping me right now. I remember Tim Ferriss interviewed the guy that talked about this in either Tribe of Mentors or Tools of Titans. I can't remember which one right now, but as you can tell, I'm a voracious reader. That is one of the things that has helped quite a bit when it comes to, being a business owner and scaling and getting new ideas. My Audible probably has like 240 books on it. The majority of them are what people would call like self-help books, if you will, business, sales, mindset, hiring, firing, scaling, all that type of stuff. So that helps quite a bit.
This interview has been so fun watching you unpack the machine that you have built, like just this well-oiled machine, but it sounds like there's been a lot of trial and error too. Kind of hitting on the operation side again, you talked about when you buy smaller mom and pop operations that you try to look to put in procedures and operations that will help that work better. What kind of things do you put in place that help those work better?
Yeah, let's talk about an extreme example, right? Which happens pretty often for us when we're trying to find really good deals that have high margin. So one of the things that happens is we'll ask for a seller's books and everything they have, and they will literally mail us photocopies of yellow legal pad. They run their entire business on paper. So that's, you can't run metrics when you run everything on paper. You can't see who's going, who's coming. Everything is basically done in a reactionary basis. So the very first thing we do is we move those facilities to a management software that tracks everything for us. So now we've saved a bunch of time. In addition to that, we'll find sellers that don't use websites at all. They have no internet presence. So you can't find them on Google. You can't find them, they have no website. You can't rent units online. So that's another huge value add that allows us to then the ability to operate using these types of procedures. Because for us, the thing that I always say is, when it comes to procedures, first of all, you need to take a step back and say, hey, can I eliminate this task? Number one. Like having to update a yellow legal pad of who has paid and who has not paid for the month, right? That takes a lot of time. So can I eliminate this? I cannot eliminate that specifically. I can eliminate the updating the books thing, but I can automate it by putting in this software, right? If I can automate it, do I need to be the one that's, inputting things into the automation, or can I delegate that off to somebody else? And usually what I tell people when you're running a business, you should really know what your time value is. And everyone thinks they know what that means, but they really don't. What I mean is every couple of years, everyone in my company, we have to do a time study where every 15 minutes during the workday, an alarm goes off and you have to write down exactly what you did for the last 15 minutes. And then very clearly, you'll start to realize, where am I losing money from a personal standpoint and what my hourly wage is. If I know my hourly wage is $100 an hour, why would I do things that are less than $100 an hour activity when I can hire somebody else to do that at a fraction of the cost? And then now I am leveraging their time. So for example, underwriting, very important, takes a lot of time, right? So say you're a $100 an hour CEO, you should not be underwriting. You should create the procedure to underwrite. Here's how you do it. Maybe create a video on how to do it. Here's the Excel sheet that I built how to do it. And then go hire an analyst to do it that maybe is paid 10, 20, even $30 an hour to do that. Because now on every one of their hours, you're making an additional $70 an hour. Because now you can focus your time on things that are tasks that are at your level of hourly earn. So for example, what I do for the companies primarily is a lot of this stuff. So big relationships and outreach. So podcasts and seminars and conferences, etc. I raise equity and I structure debt. Those are the three things that I do for my company, nothing else, because everything else is someone else's specialty or can be done by somebody else that has a lower per hour earn